Hi, in this video, we are going to discuss the step 4 of IFRS revenue recognition model, which is to allocate the transaction prices to separate performance obligations. In the past videos, in second step, we learned about the separate performance obligations, which are basically the distinct goods and services which are different from each other and sold separately as well, and their performance is not dependent on one another. The that we in the last video we have also learned about the transaction prices, whether it includes the fixed price plus the variable component of it, the time, the financing cost of it, and also the fair value of the in-kind recognition plus the pay amount pay back to the customers. So we have looked at those examples. Now we understood what is the goods and services separate performance obligations, what is the transaction price. The next step is to allocate that transaction price on separate performance obligations. So the idea here is to understand the amount of consideration for each separate performance obligation that we are doing, either whether goods or services. And the normal way of allocating the transaction price into the separate performance obligation is based on the standard standalone selling prices. So usually you will use a standalone selling price for allocation, except if we have given a bundle discount, then we will allocate the discount based on on each goods and services equally, unless there is a specific breakdown being given. If there is no specific breakdown given, then the allocation would be based on the total standalone price compared to the bundle price and how much discount we have given, and that discount will allocate on the in the proportionate to the individual services. So for example, here, if let's say we are selling the product A, B, and C, and there are two choices that we have done. Is one is we have bundled the product B and C into one, and we sold it for $60, and we sold the product A for a normal price $40, or we combine everything together and we sold it for $100, right? So in that case, if we sell everything as a bundle and sold for $100, the allocation would be for 40 divided by the total price, which is 140 multiplied by 100, and the discount would be allocated equally to every services: product A, product B, product C. But in case we have combined only product B and C and we sold it for 60, means we leave 40 for product A. In that case, the allocation would be different, and then it would be 40, 30, and 27. So it depends on what is the contract and what is written in the contract. If nothing specified, then it will go equally. If something is specified, and there is a specific amount being mentioned for certain product, then the amount will be allocated only on those products, not on the entire range. So that is the one way of allocating the standard price. The second criteria is of allocation or allocating the consideration of variable amounts. So as we have seen in the past example, the term of variable has been specifically mentioned in the contract. And if there are variable payments which relate specifically to the entity's effort to satisfy the price, then we allocate the variable amount entirely to the PO inconsistent with the allocation objective. So the variable amounts also will be allocated based on the performance obligations. What is the variable, and where the additional cost of the performance obligation is lying, and that amount, the additional amount, the variable amount, will be allocated to that particular performance obligation or that particular product. So that is the one way of allocation. The next item which we have to understand is the standalone selling price. So what is the standalone selling prices? Because we just the basic idea is to allocate based on the standalone selling price. So the idea is to understand what exactly is the standalone selling price. If the company has a history of selling the goods and services that we are selling in the market at certain prices, at the contract, at the starting date of contract, not after the contract, but at the time of making a contract. If those services are normally sold separately, then their market price would be considered as the standalone selling price. If the item are being sold on varying prices to different customers, then the company can take an average of that, or the list price of that product as a standalone selling price. So normally you would have making estimates, or you would observe the selling price of the goods. If the selling price is not observable, selling price is not available, then you will make estimates, right? So for making the estimates, you need to consider all the information available, which includes the market assessment, includes the cost plus margin approach, it can be the residual approach, or it can be a combination of both. So if let's say the standalone observable price, or there is no standard alone selling price which is available in the market, and the company is not selling it to the market, then the another way would can be also to estimate the cost of doing that service, or selling that product, plus a standard margin which the company is making. So you can take the overall gross profit percentage, estimate the cost of sales, and based on that you can estimate what would be the value of the residual, what would be the value of, if the company is selling in the market, what would be the selling price of that particular product. So that is the one way of the standard establishing the standalone prices. So let's take an example. So normally it can be a very big issue for some companies, because there are price discriminations among the different consumer groups, and some POs are not normally sold at separately, and sometimes the standalone selling prices are always changing because of the demand and supply factor. You may also be changing on the based on the seasonality. So how you are going to allocate the cost, allocate the standalone selling prices. So in that case, usually you will the company might have to make a policy at the time of making the contract. What is the selling price? If yes, there can be different consumer groups where you are selling the same products and services at different prices. However, so you may need to either use the consumer that the normal price of that consumer segment, or you can take an average of those prices. So the company has to make it clear on their revenue recognition policy,